Gold just did something it hasn't done since 1980, and almost nobody is talking about it the right way. Right now, as I'm recording this, gold is trading around $4,070 an ounce. That sounds like a big number, and it is. But here's the part that should stop you cold. Back in January of this year, gold hit an all time high of about $5,600 an ounce. So do the math with me for a second. That's a drop of roughly 28% from peak to where we are today. And silver? Silver got hit even worse. Silver peaked at around $121 an ounce earlier this year. Today, it's sitting near $58. That's a decline of over 50%, cut in half in a matter of months. Now, if you've been watching the news, you've probably seen headlines calling this a correction, a pullback, a healthy cooling off after a hot run. And sure, that's technically true. But here's what nobody's explaining to you. Why now? Why this fast? And why are the same central banks that spent the last 3 years buying gold like it was going out of style still quietly buying more of it, even as the price craters? That's the real mystery. That's what we're digging into today. Not just what happened to the gold price, but what it tells you about where the real money, the smart money, the institutional money, the money that runs the actual plumbing of the global financial system thinks this is all headed. And by the end of this video, you're going to understand something most financial news anchors either don't understand themselves or aren't willing to say out loud on television. So here's what's actually happening, why it's happening, and more importantly, what it means for your money, especially if you're getting close to retirement or you're already living off your savings. Let's start with the basics, because I never want to assume you already know this stuff. When people say gold is up or gold crashed, they're talking about something called the spot price. Basically, the real-time price of 1 troy ounce of gold if you bought it right now, today, on the open market. A troy ounce is just a specific unit of weight used for precious metals. It's slightly heavier than the ounce you're used to for, say, a bag of chips. When gold corrects, it means the price has fallen a meaningful amount, typically defined as 10% or more from a recent peak. A bull market is just a period where prices are generally rising over time. And when I say central banks, I mean the institutions like the Federal Reserve here in the US, or the People's Bank of China, or the National Bank of Poland, the organizations that control a country's money supply and interest rates, and that also, quietly, hold enormous stockpiles of gold as part of their reserves. Keep that term reserves in your head, because it's going to matter a lot in a few minutes. Okay, reason number one why this crash is happening: interest rates. Here's the basic relationship you need to understand. Gold pays you nothing. If you hold a bar of gold in a vault for 10 years, it just sits there. It doesn't pay you a dividend, it doesn't pay you interest, it doesn't send you a check. Meanwhile, if interest rates are high, you can put your money into a savings account or a short-term treasury bond and just get paid to sit there instead. So when rates go up, or when the market expects them to stay high or go higher, money tends to flow out of gold and into interest-paying assets. That's classic textbook economics. And that's exactly what's happening right now. As of this week, the 10-year Treasury yield is sitting around 4.5%, and the 30-year just pushed above 5% for the first time in a while. That's a big deal. When you can lock in a 5% guaranteed return from the US government for 30 years, gold, which pays you zero, suddenly looks less attractive to a certain type of investor. On top of that, there's a new Fed chair, Kevin Warsh, and the Federal Reserve's own internal minutes show the committee is deeply split, something like 9 members leaning toward more rate hikes, 8 leaning against. That kind of split, that kind of uncertainty at the top of the world's most powerful central bank creates volatility. And volatility, in the short term, often hits gold and silver traders hardest because so much of the daily trading in these metals is done with borrowed money, leverage, which gets margin called and liquidated fast when prices swing. That leads to reason number 2, the dollar. Gold is priced in US dollars globally, so when the dollar gets stronger, meaning it buys more of other currencies, gold, priced in dollars, tends to get cheaper, almost mechanically, even if nothing else about the world has changed. And right now, with yields rising and geopolitical tension pushing money into the perceived safety of US treasuries, the dollar has been strengthening. Combine a stronger dollar with higher rates, and you get exactly the kind of 1-2 punch that sends gold prices reeling in the short term. Now, here's reason number 3, and this is where it gets interesting, because this is the part most coverage skips entirely. This isn't just a market-driven crash. Some of it is being engineered, or at least accelerated, by deliberate policy decisions. Let's talk about China. In the middle of this correction, Chinese banks made a very unusual move. They raised something called the margin requirement on gold trading to 140%. Now, remember what a margin requirement is. It's the amount of collateral, of your own money, that you need to put up in order to borrow the rest to make a trade. Normally, margin requirements are well under 100% because the whole point of margin is leverage, using a little of your own money to control a lot of someone else's. When China pushes that number to 140%, they're not just discouraging leverage, they're demanding you put up more collateral than the position is even worth. That's not a market response, that's a policy lever, pulled on purpose. The official reason given was investor protection. Gold's volatile, retail traders were getting hurt, so the government stepped in. And maybe that's part of it. But look at what that move actually does in practice. It kills speculative, leveraged paper trading in gold, the fast money, the short-term bets, while doing almost nothing to stop actual physical gold from moving into long-term hands, like central bank reserves. It's the kind of move you'd make if you wanted to shake the fast money out of the market without discouraging the slow, patient accumulation happening underneath it. Now, hold on. You might be thinking, okay, that's one country, one policy tweak. Why does that matter for me? Fair question. Here's why it matters. It's not isolated. It's happening at the exact same time as reason number 4, central bank buying that simply has not stopped, even as the price falls. Let's look at the actual numbers, because this is the piece that should really make you sit up. In 2025, central banks around the world bought a net total of 863 tons of gold. That's down slightly from the more than 1,000 tons a year they were buying in the few years before that, but it's still an enormous number historically. Then, in the first quarter of this year alone, central banks bought 244 tons, a 17% increase from the quarter before. Poland alone, through its central bank, bought over 100 tons in 2025 and kept buying into this year. China has been adding gold too, even while its domestic banks are simultaneously making it harder for regular citizens to speculate on gold with leverage. Read that combination again. Harder for the public to gamble on gold with borrowed money, easier and more consistent for the state itself to quietly keep adding real, physical gold to its vaults. Does that sound like an institution that thinks gold is a bad long-term bet? Or does it sound like an institution that wants the price lower, temporarily, so it can keep buying more of it for less? I want to give you a sense of why central banks care about this so much. And to do that, I want to walk you through 2 moments in history that rhyme with what's happening right now, because the smartest way to understand the present is to understand it's not actually new. Let's go back to August 15th, 1971. President Nixon goes on national television on a Sunday night and announces that the United States is suspending the convertibility of the dollar into gold. For those keeping score at home, up until that moment, foreign governments could technically take their US dollars to the American government and demand actual gold in exchange, at a fixed rate, $35 an ounce. That system, set up after World War II, was called Bretton Woods, and it was the foundation of the entire post-war global financial order. But by 1971, the US had printed and spent so much, fighting a war in Vietnam, funding domestic programs, that there wasn't nearly enough gold in Fort Knox to back all those dollars floating around the world. Foreign governments knew it. They started lining up, quietly, to cash in their dollars for gold before the music stopped. And rather than let the vault run dry, Nixon simply ended the promise. Overnight, the dollar became what's called a fiat currency, meaning its value isn't backed by a physical asset anymore. It's backed purely by government decree and public trust. That single Sunday night broadcast is the reason gold has been allowed to float freely in price ever since. And it's why, over the following decade, gold went from $35 an ounce to over $800 an ounce by January of 1980, an increase of more than 2,000%, as the world tried to figure out what money was actually worth without a gold anchor holding it in place. And then, here's the second parallel. Gold crashed hard. After hitting that all-time high around $850 in January of 1980, gold entered a brutal, multi-decade slump. It lost something like 70% of its value over the following years, and it took over 2 decades, into the early 2000s, for gold to meaningfully challenge those highs again. Think about that. If you were a gold investor standing at the top of that mountain in January 1980, feeling like the smartest person in the room, You then had to watch your investment bleed value for the better part of 20 years. Imagine holding on through that. Imagine explaining to your family year after year why you were still holding gold while it kept sinking. That's the level of patience and pain that's baked into precious metals markets after a euphoric peak. Now, here's the but that changes the whole story. The crash after 1980 happened because inflation was actually getting tamed. Fed Chairman Paul Volcker took interest rates up to nearly 20% to break the back of inflation. And it worked. Painfully, but it worked. Cash and bonds became attractive again because you could actually earn a real inflation beating return holding them. Gold's appeal specifically comes from being a hedge against currency debasement and crisis. So when the crisis genuinely resolves, gold's shine fades along with it, sometimes for a very long time. So the real question for you and me, sitting here in 2026, is this. Does our current situation look more like the crisis is being resolved, the way it was in the early 1980s under Volcker? Or does it look more like the crisis is being paused, while the underlying pressures, debt, deficits, geopolitical fracture, keep building underneath the surface? Let's bring in the second historical parallel, because it points a different direction. 2008. In the fall of 2008, as Lehman Brothers collapsed and the global financial system seized up, gold actually fell too, sharply in the initial panic, because everyone needed cash immediately and sold everything, gold included, just to cover margin calls and stay solvent. People watched gold drop and assumed it had failed as a safe haven. But that initial crash was a liquidity event, not a verdict on gold's long-term value. Within about a year, as the Federal Reserve slashed interest rates to near zero and started buying trillions of dollars of bonds, a policy called quantitative easing, gold didn't just recover. It went on to triple over the following 3 years, hitting new all-time highs by 2011 as investors worried the flood of new money would eventually show up as inflation. That's the pattern I want you to hold on to. Short-term crashes driven by liquidity, leverage, and panic selling have historically been the entry point, not the exit point, for the next leg higher, as long as the underlying reason people wanted gold in the first place hasn't actually gone away. So, has it gone away? Let's use the physical analogy I always come back to because it makes this click for people who don't live and breathe finance. Think of the entire global monetary system like a massive, slow-moving cruise ship. For 80 years, that ship has been steered by one captain at the wheel, the US dollar, because after World War II, the dollar became the default currency the whole world used to trade oil, settle debts, and store reserves. Now, a cruise ship with one captain runs smoothly, as long as everyone trusts that captain to steer straight and not run the ship, or the passenger's savings, into the rocks. But over the last 2 decades, and especially the last 5 years, more and more passengers on that ship have started looking at the captain's logbook, the growing pile of national debt, the constant printing of new money, the political dysfunction, and quietly asking, what happens if this captain makes a mistake, or simply can't steer straight anymore because the ship's gotten too big and too indebted to turn? Here's the thing about a cruise ship, though. You can't just jump off in the middle of the ocean. If you're a central bank holding trillions of dollars in reserves, you can't sell it all overnight. That would crash your own holdings and tank confidence in the very system you depend on. So what do these institutions do instead? They start quietly building a lifeboat. Not abandoning the ship, just making sure that if something does go wrong, they're not entirely dependent on one captain's judgment. That lifeboat, historically, for 5,000 years of human civilization, across every empire and every currency reset, has been gold. It's the one asset that isn't anybody's liability, doesn't depend on any government's promise, and can't be printed into existence by a committee vote. That's the lifeboat these central banks have been quietly, patiently loading up for the last several years, even and especially when the price gets choppy. Because when you're building a lifeboat for a storm you genuinely believe is coming, a temporary discount on lifeboat materials isn't a reason to stop, it's a reason to load faster. Now let's talk about what the institutions are actually doing, with names attached, because vague smart money talk isn't useful. Specifics are. Poland's central bank, under its long-serving governor, has been one of the most aggressive sovereign buyers on the planet, adding over 100 tons of gold in 2025 alone, and continuing to add through this year, explicitly citing a desire to reduce dependency on the dollar and euro-denominated reserves. China's central bank has been adding gold nearly every month this year, even as its domestic regulators simultaneously tighten the screws on retail speculation. Again, that combination of harder for the public to gamble, easier for the state to accumulate that I flagged earlier. Uzbekistan and Kazakhstan, two countries you may not think about often, have quietly become notable buyers too, part of a broader trend of smaller, resource-rich nations diversifying their reserves away from a dollar-only model. Meanwhile, Turkey and Russia have been net sellers this year, but even that's more nuanced than it looks, because a chunk of Turkey's reported selling has actually been through gold swaps, a financial maneuver that lets a central bank access short-term liquidity without permanently giving up its underlying gold ownership. It's less we don't want this gold anymore, and more we need cash right now, and this is the collateral we're using to get it. And underneath all of this is a slower structural shift that's honestly the most important data point in this entire story. For the first time in modern history, gold now represents a larger share of global central bank reserves than US Treasury bonds do. Sit with that for a second. For 80 years, the safest, most trusted asset for a central bank to hold, instead of gold, was US government debt. That relationship has now flipped. That's not a headline that trends on social media because it's not dramatic or emotional. It's just quietly, mechanically true. And it tells you that the institutions steering the largest pools of money on the planet have already made a decision about where they want more of their long-term security to sit, regardless of what the price does month to month. There's also a regulatory piece worth understanding, because it explains why some of the largest Western banks suddenly care so much about their gold positioning. Under global banking rules that were updated in recent years, often referred to under the umbrella of Basel III reforms, the way banks are required to treat physical gold on their balance sheets changed. Historically, big banks could trade enormous amounts of paper gold, futures contracts, promises to deliver gold, without necessarily holding the metal itself, treating it more like a speculative instrument than a real asset. The rule changes pushed banks to treat physical allocated gold more like the safe, high-quality asset it's always claimed to be, which incentivized many of them to make sure their actual gold holdings matched their promises more closely, rather than running the kind of thinly backed, leveraged positions that would blow up spectacularly if the price ever spiked hard and fast. If you're a bank that had sold far more gold IOUs than you actually had metal to back, and if you had reason to believe the long-term trajectory of the price was higher, you would want those rules changed before that mismatch became a problem, not after. Now, let's tie the pieces together, because I promised you at the start this would all connect. The short-term story is straightforward. Higher interest rates, a stronger dollar, deliberate policy moves like China's margin hikes, and a leverage-driven shakeout are pushing the price of gold and silver down hard, fast, and painfully for anyone who bought near the top. That part is real, it's happening, and it may not be over. Some analysts are even flagging $3,700 as a possible next support level for gold if the pressure continues. If you bought gold in December or January, I'm not going to pretend that doesn't sting. But the long-term story, the one written in central bank purchase reports, in reserve composition data, in regulatory rule changes, in the quiet, unglamorous accumulation happening ton by ton, month after month, regardless of price, tells a very different tale. It says that the institutions with the longest time horizons, the deepest pockets, and the most complete information about the health of the global monetary system are treating this correction the same way a disciplined investor treats any sale, as an opportunity to buy something they already wanted more of, at a better price, without changing their long-term plan one bit. So what does this mean for the three things most of us actually care about? Stocks, gold, and the dollar. On stocks, elevated interest rates and bond yields above 5% on the long end make borrowing more expensive for companies and make bonds more competitive with equities for investor dollars, which historically creates real headwinds for stock market valuations, especially for the kind of high-growth, richly priced companies that have led this market for years. On the dollar, the very fact that so many nations are actively working to diversify away from dollar dependency, even while continuing to use it day to day, suggests a slow, multi-year erosion of the dollar's unquestioned dominance. Not a collapse, but a gradual rebalancing that plays out over years, not headlines. And on gold specifically, a sharp, leverage-driven correction inside a longer structural accumulation story is exactly the pattern we've seen before, in 2008 and in other cycles. A shakeout of weak, over-leveraged hands followed eventually by a resumption of the underlying trend, once the panic selling burns itself out and the patient buyers, The central banks, the long-term allocators, are left holding a larger share of a smaller float. Now, look, I need to pause here for something because I think it's genuinely relevant to everything we just talked about. If you're getting close to retirement or you already are retired and you've got a good chunk of your savings sitting in a traditional retirement account, this exact dynamic, the shifting relationship between the dollar, bonds, and hard assets like gold, is precisely the kind of macro shift that can quietly erode purchasing power over a retirement that might last 20 or 30 years. I put together a free guide that walks through, in plain language, how people are thinking about protecting and diversifying retirement savings against exactly this kind of environment. There's a link below this video, or you can scan the QR code on the screen right now if you're watching on your phone or a TV. It costs you nothing, and it takes about 5 minutes to read. Okay, anyway, back to it. Let's go a little deeper on one more piece, because I don't want to leave you with a half-finished picture. The relationship between gold and interest rates isn't as mechanical as the textbooks make it sound, and here's why. Rates only really hurt gold when they're rising for the right reason, meaning the economy is strong, inflation is being genuinely tamed, and real inflation-adjusted returns on cash and bonds are attractive. But if rates are elevated because inflation itself is stubborn, because oil prices are spiking due to geopolitical tension, because tariffs are pushing up the cost of imported goods, because government deficits keep requiring more borrowing, regardless of what the Fed does, then high nominal rates don't actually translate into high real returns. And right now, we're seeing exactly that kind of tension. Oil prices jumping on Iran-related concerns, a Federal Reserve that's internally split on what to do next, a new Fed chair still finding his footing, and a government deficit that keeps growing no matter which party is in charge. That's a very different, much messier picture than the clean Volcker beats inflation, gold sleeps for 20 years story from the 1980s. It looks, honestly, more like an economy trying to hike rates into a supply-driven inflation problem it can't fully control. And that's historically been a much more favorable setup for gold over the medium term, even if the next few months stay choppy. I also want to address something directly, because I promised you real talk and not fear-mongering. I am not telling you gold is guaranteed to hit $6,000, and I'm not telling you the dollar is about to collapse next Tuesday. Nobody honest can tell you that. What I am telling you is what's actually verifiably happening. Central banks are still net buyers of gold after an 863-ton year and a 41-ton month as recently as May. Gold now outweighs treasuries in global reserves for the first time in the modern era. Regulatory changes have pushed major banks toward holding more real, physical gold rather than paper promises. And every one of those facts was true before this correction started. And every one of them remains true today, even with the price down almost 30% from its peak. The people who actually run the plumbing of the global financial system are behaving like people who expect to need that lifeboat eventually. The question isn't whether you should panic. It's whether you're paying attention to what they're actually doing, instead of just what the headline price is doing this week. So let me tie this all together. Gold and silver just went through one of the sharpest corrections in years, driven by higher rates, a stronger dollar, deliberate leverage cooling policy moves out of China, and a jittery, split Federal Reserve trying to figure out its next move under new leadership. That's the surface story, and it's genuinely painful if you're holding positions from the highs. But underneath that surface, the institutions with the longest memory and the deepest information, the central banks, have not stopped buying. They bought through 2025's record prices. They bought through the first quarter of this year. They were still net buyers as recently as May. And structurally, gold has now become a bigger piece of the world's reserve assets than US government debt for the first time in living memory. That is not the behavior of institutions that think the story is over. That's the behavior of institutions quietly finishing the lifeboat while everyone else is arguing about the weather.